All right, all right. We've got Vaughn Respa and Kenny Ross here, some of my big life financial services agents. Today, we're going to talk about final expense insurance, whole life insurance, IUL, and kind of contrast um, the two or three different types of insurance. And so these guys have been in the insurance game for a long time. So they've sold lots of different types of policies. So we'll talk about which policy best suits an individual. And so we'll start with you, Kenny. Why don't you introduce yourself and just kind of tell us how long you've been in insurance and what are some of the things that you sell?
Okay, I've been in insurance for like over 30 years. I've sold every type of policy, UL, whole life, term, you name it, I've sold it. So I have a wide range of products that I offer. And to this day, I sell those different types of products.
Okay, what about you, Vaughn?
Well, I've been in the business since 1980. That's approximately 42 years. And I've sold, first started off selling whole life insurance with a company called Mass Mutual back in 1980. But I've sold all different kinds, and all of them had a special places. No one policy is for everybody. That's what makes it so good.
Right. And so I know, Kenny, one of your favorite types of policies to sell is final expense. And so, first of all, what is final expense insurance? What is it?
Final expense is the crown jewel of life insurance. It's the last shot you have of getting life insurance. If you've been putting it off and I don't need it, procrastinate, I have it from my job, and then finally you get close to retirement, you get past 50 and you start losing friends and people will start passing. You say, you know what, it's time I get some life insurance. And the last good shot at it is when you go for a life insurance called final expense. That's a product that covers you from cradle to grave, is permanent. If you have a funeral, this is the plan that's going to cover that. So it is easy to get, it's flexible, and it's permanent, and it's your last shot at getting a policy. Because once you get up in age, if you pick up a lot of medical problems, then it becomes hard to get the big face amounts. But the little ones from 5,000 to 50,000, they can give that to you readily.
Okay. And Vaughn, generally speaking, on a final expense policy, what's the death benefit? What's the coverage? What's the amount that you can get? What's the range?
Anywhere from five, sometimes depending on the company, you could go up to 50. It depends on the company, and we have a great range of companies that we can choose from.
And so you can get anywhere between $5,000 and $50,000 worth of coverage, worth of death benefit.
That's correct.
What do the premiums look like? What's the monthly payments on a policy like that?
Well, you want to
Go ahead, Kenny. One of you guys, go ahead. Looks like you guys are freezing.
talk anyway. Right. On average, it can run you about $100 a month.
Okay, about $100 a month on the premium. So I think they said about $100 a month on the premium. Generally speaking, final expenses insurance, generally for people that are getting up in age, they want to make sure that they're not a burden on their loved ones once they do pass away, and so they get the policies so that their burial.
I've seen people really thought that they could get insurance at a very, very cheap rate at $9. That doesn't make any kind of sense whatsoever. So you have to actually talk to an agent to find out what you have. You can't look on TV for insurance.
Right. You know what? It's interesting that I said that because I think it was the same way. Buying from a radio ad or a TV ad is like buying a brain surgery kit.
But why do you say that?
Because if you have an agent, he has a lot of different companies that he could shop and get you the right product that fit your ailment. Whereas if you go with a TV company or a radio, they have a cookie cutter thing. They throw everybody into that same pot. And it may not be the right pot for you. You may be paying too much, or you may lose coverage or get not paying enough, or you can get your policy canceled and then get a bad program where it's in the history of MIB Medical Insurance Bureau, and then you can't get a policy at all. They can mess you up. And then you won't be able to get a policy if you say the wrong thing. See, we know what to put down and how to get it across that you can get approved. Because if you don't get approved, we don't make any money. So we do our best to get you the right product and the right premium that you can keep up and afford and not lose and let it lapse. So there's a lot goes in. It has to be designed. And there's only an agent can do it. If you go call somebody on the 800 number, they don't know you. They don't know nothing about your health. They don't know about your size. Because if you put down maybe you're 400 pounds, and that would knock you out of a lot of things. But maybe if you was 350, everything would work out. So we know how to make it work for you. That's why they don't like agents, because we work for the client. We care more about our customers than we do about the company.
Insurance is a very intricate thing. That's why the test is so difficult to pass, because you're almost next to an attorney, because you really have to know what you're talking about in order to help people properly. And that's why I think it's.
Uh-oh. He froze.
Kenny, talk about the alternative. What's the alternative of, let's say, someone 60, 70 years old with no insurance whatsoever, and they pass away, no final expense insurance? What's the alternative? What's the consequence of that?
Well, the worst policy is having no policy. If there's no such thing as a bad insurance policy, even if you pay too much for it, or maybe it's not a lot of coverage, but it's better than having nothing. So it's better to have any policy. It's better than not having any policy at all. So if you don't have insurance, you should have it. It's selfish not to have life insurance, because someone has to bury you. You got loved ones behind. It's a very selfish thing not to get insurance. Everybody should have a policy.
And with the policy, how difficult is it to get a final expense policy?
It's not very difficult at all, because they have different categories that you could qualify for. Let's say you have the worst health ever. Let's say you have the big C, or something, or the big A, or something, and it's really bad. You can get a guaranteed issue plan where there's no medical questions. You just got to stay alive for 2 years. If you stay alive for 2 years, the third year it goes into full benefit. But if you die by accident the first 2 years, they'll give you the whole full death benefit. So all you do is just stay alive for 2 years, and you got to have coverage. So anybody can get a final expense product. Anybody can get one.
With no medical.
With no medical.
Now, on a final expense policy, I know that it's permanent insurance, as opposed to a term policy. This one's permanent. It's a whole life policy. Is there any on a final expense? Is there any cash value that you're calculating?
Yes, it has cash values that you could borrow from, or you could cash surrender. It depends on what your situation is, but you are able to build up cash values, because some companies have dividends. So you can, like a mutual company, they have dividends, they invest it, and they give you some of that money back. So it builds up cash value.
That's good.
Mm-hmm.
And so what's
as opposed to term, which is short for termination, it's temporary, there's no cash values. And then you can outlive the term policies. So if you talk about final expense, if you know that you want to leave something back for your family, you have to get a permanent plan.
Okay.
And if you got some life-threatening things, diseases going on, you need whole life. Whole life will be there. So one day you're going to die, and one day that policy can be taken to a funeral home, or someone can cash surrender it and get the proceeds.
And so contrast that with, let's say, a term policy that's temporary insurance. So what's the difference between a term policy and, let's say, a final expense policy?
A term product is designed for younger people who have mortgages, they have children, and they can't afford to get $1 million policy straight up. So they take out a temporary policy. So if they die in the next 10 to 15 years or 20 year or 30 year, then their family can get it. But if they live past the 30 years, then the term policy expires, and there's no need for it. Just a temporary need of a large amount of money in a small period of time. And normally it's from when you get a mortgage protection, or you have children and you just family, that you need a lot of coverage, because you want to be able to replace your income. Because if you're the breadwinner and you die, your family's going to be missing that money. So you want to get a large amount, at least $1 million.
And what's the age range you see when you're writing final expense policies? What's kind of the age range?
Anybody, I would say, when they getting out of college, high school, graduate, about from 18 up through, say, 45.
Oh, really?
Yeah.
So
once you get past 45, 50, then you need to get something a little more permanent. And you don't want to really mess with term, because after a while, the price every 10 or 15 years, when you renew it, the price goes higher and higher. And then at some point, you can't afford it. When you get in the 60s, you won't be able to afford it, because the premium turns out to be like $1,500 a month or something like that. So it runs away. That's designed for that.
Okay. And then, so let's switch over to something that's kind of near and dear to my heart, is the IULs, the Index Universal Life Policy. Both of you guys contrast the final expense to what's an IUL. And the reasons why I love IUL is because you can really build cash value inside of that policy tax-free. Also gives you a death benefit, but also you can become your own bank. And so what do you guys see as the differences between an IUL, Index Universal Life Policy, and the final expense? And then we'll talk about kind of the demographics.
Okay. All of that you just said is true. But the one thing that you need to understand, if you go to Burger King, you're looking to do what? Buy burgers. If you're going to go to Starbucks, you're looking to buy coffee. If you go into a life insurance company, the first thing you should be thinking about is buying life insurance. That's the main thing you go to life insurance for, is to buy life insurance, and life insurance. Now, as far as pouring money in and investing, if you want to invest, there's a lot of other things you can do that will build up better. But if you have a lot of money that you want to, if you have, you're well-heeled and you got a lot of money, then an IUL, you want to be able to hide the money from IRS, tax type of thing, you won't get taxed. Then you could throw some money into an IUL. It doesn't invest right directly into the market. It's just the interest way of them adding money to your policy. And it's good. But there's a lot of other better ways of investing if that's what you're looking to do. But if you go to a life insurance company, you better want to know that you're buying life insurance, that when you die, you're going to leave money behind. That's the real reason for buying life insurance.
But there's another product that's not as popular as...
Yes, I think Von's having some issues with his home.
But I think you're probably talking about a guarantee, a universal life that the coverage stays all the way through 120. Matter of fact, I wrote one of those last night on an 82-year-old female in Texas. She's in good health. She just had a little high blood pressure, but she said she didn't even take medicine for that. And I wrote her a $50,000 universal life product. Comes out to about $345 a month, and it's going to cover straight 100.
Well,
and then when
what
she gets
I was talking about,
Go ahead, Juan.
We have whole life products that don't pay as higher interest as universal life, but they are guaranteed.
Right.
And they are not as popular as or near as sophisticated as IULs. But you can dump money in there also and borrow against them, and your money is collateral. Your money is doing two things at the same time. That is a miracle. That is the greatest idea in the world.
Yep.
That you never had to spend your money. You can use all your money as collateral. That's like a money pawn shop. You put your
He's going.
I mean, he's gone again. All right. So IULs, Kenny, what age group, what demographics are you selling IULs to?
You can sell it for any range. But if someone's looking to get money, pile up money, and not have it taxed and let it accumulate and Rule 72 double and all that, there's a good product for that, because that's the best interest rate you can get, except if you go to a variable, which is a real sophisticated product, and that you got to come out of the regular agent stuff, go to a stockbroker to do those type of products. But it's an interesting product if someone who has money. If you have a lot of money and you want to find something to do with other than put it in the bank, then IUL is the way to go. That's definitely the way to go. But most of the market, the general market, people are just looking for insurance. They want to get approved, because if you get a large policy, a lot of stuff goes in. You want to take exams and check your history and your financial stuff. They start prying into your business when you want to get the large policy. So you better know what you're doing when you step into that world.
And so I always tell the story of in the Jewish community, when one passes away, 2 millionaires are created because they understand.
They got insurance on each other.
Yeah, they get insurance on each other. African American community, we don't do that. Why do you think that's the case?
Because we didn't grow up with all the financial information and education. We're financially illiterate, so we don't know all those tricks and all that stuff. So we're getting smarter now, though. We're catching up. So it's coming.
And so I think that's kind of what our job is here at Big Life Financial Services.
Correct.
Is to really educate people on the power of insurance, life insurance, and dumping money into insurance policies. I was reading something this weekend where it said that when the banks are investing their money, they invest their money in insurance policies.
Yeah,
because they get a guaranteed rate of return. But more importantly, they're not paying any taxes on that money. And so as an individual, it's the same thing. We get almost a guaranteed return on your money, and we're not paying taxes. And we have the ability to be our own bank. We can borrow money from ourselves, from our cash value. You can borrow money from your own policy and invest it in real estate. And so that's what I'm getting ready to do with my daughter. She's had an IUL for about 10 years. She's 23 years old now, and she's going to borrow the money. She's got about $25,000 in her cash value. So she's getting ready to buy an investment property. She's going to use the money in her IUL.
But once she takes the money out, then her face amount of her policy is going to go down. If some people want to play that, it's good. But most people just need coverage so that they can leave something back for their family, because we're insurance poor. We don't get the 100,000, the $1 million policies. Everybody should have like $1 million if they can get it. So we need to get more insurance than to kind of be selfish, kind of looking, I could take this money out. And you never know how long you're going to live.
I apologize, you guys. We're having some.
Yeah.
Seems like
If
we're
you
having.
want to invest your money and buy real estate, go directly.
Having some technical issues here. So let me just talk until they get back here. I do believe, and sounds like Kenny disagrees, but I do believe in building up your cash value. Go ahead, Kenny.
Okay. As a group, if I'm thinking broadly, we need face amount, larger face amount policy. So when we pass, we leave our family some money they could do something with. That's where I'm coming from. You buying life insurance, I want to get you the most bang for your buck.
And so, Kenny, I agree with that, but I also agree in investing and building wealth. And so, if you can use your cash value to help you build wealth and taking the cash out, buy real estate, refinance, and put that money back, now you haven't really lost anything in your cash.
Let's say you take the money out. When you take the money out, that face amount of that policy goes down. And let's say
it's still your money is still growing with the cash, I mean, with the face amount that was once in there.
There's only so much you can take out, and once you and when you get to that limit, you cut off, and you'll find that out when you go to take money out, because there's penalties and stuff like that that kick in. So
yeah, but if I'm able to purchase,
and if you overfund it, if you pour too much in it mix, it becomes a modified endowment contract, and then it gets taxed. You need to talk to a CPA or accountant when you start playing around with trying to get money out of it. But my basic premise that everybody buy life insurance to have coverage, as much coverage as you can. That's going to benefit your family.
And so, Kenny, just let me talk for a second, okay? Just let me talk.
I'll try. Go ahead. My mouth is zipped. Go ahead.
Thank you. Let me think. And so I totally believe, I agree with what you're saying, but and so we're not talking about overfunding. We're just talking about pulling the cash value out, being your own bank, investing in real estate, and then putting that money back, being your own bank. There's nothing wrong with that. As a matter of fact, that's how you build wealth. That's how the wealthy build wealth, through their cash value accounts. Now, you can put more and more money into your IUL to overfund it. And so the more money in there, the more it's going to grow. Now, it can create a mech, but honestly, there's nothing wrong with that. There's nothing wrong if you have whatever, $100,000, $500,000, $1 million in cash value, and the interest is growing, and it creates
when the interest is higher than I get all that.
Absolutely. And so if you have to pay, hold on, Kenny, hold on. I told you this.
Sorry, my bad.
Because honestly, Kenny, this is a different way of thinking. And I understand how you're thinking, kind of old school. But if I have $1 million in my account, cash value, that I'm pulling out, putting back, pulling out, investing in real estate, and I have more money, more cash value than I do, my death benefit, it just simply means I've got to pay taxes on what's over that. But if I'm getting more money and investing more, I'm okay with creating a mech. It's okay. It's not a bad thing. It just means that you've got a lot of money that you have to play with to be your own bank. And so there's pros and cons, but the way I see it is you're building wealth. What you're saying almost rarely happens, though. It's almost rarely, probably you've probably seen once or twice or not at all, that someone has more cash value than their face value. But I do want to educate on being able to pull that money out and investing it. So now you're growing your cash value inside of your insurance policy tax free, and so you're building that up. But then you're also building, Kenny. You got to listen to this.
Mm-hmm.
You're also building a portfolio of real estate that's going to perform probably even better than the money that's in your IUL, but at the same time you still have a death benefit. Now the death benefit might not be that high, and I don't even want it to be that high. The death benefit doesn't have to be $1 million because there's no living benefit for you as a policy holder to use that $1 million death benefit when you're dead and gone. One last point. Why not build up that cash value, invest it in real estate, so that while you're living, you can take advantage of that. You can retire a lot sooner. You still have the tax-free money inside of your account. You've got, for example, I just say real estate because I'm, real estate man. So you've got a portfolio of real estate, and let's say you don't have $1 million face value in an insurance policy. Let's say you have $300,000. You've got a $300,000 death benefit to your loved ones, but now they've got a couple $1 million worth of real estate that they will inherit, and they'll have money in that cash value account.
Most people don't want to deal in real estate. Some people don't want to even get into real estate. I'm just trying to make sure people are covered, which we don't have. There are people die and they're only leaving 10,000, 15,000, 20,000. We need to correct that problem first. And what you talk about is for a minority, a small faction of our community. That investment stuff fits for. But what we need to do is get people covered, period.
So we do need it as
people just need basic life insurance when they die. That's the first priority, is to get people covered so they not only just their funeral, but leave something back for somebody to go to school, college, open businesses, all buy real estate.
I definitely agree. And I do think as a people, as a community, we're underinsured.
Yes.
We're definitely underinsured.
We need to get that problem solved first.
All right. So let's get our people in our community educated and get them insured. And all I'm saying, Kenny, is once we get them insured, now what's the next step? How do we go from getting insured, which we need to be so that we're not a burden on our loved ones when we pass away, to building wealth, utilizing that cash value? To me, that cash value just sitting there, and I come from a different mindset, but that money is just sitting there. Why not use it? Because you can use it. You can use it in a way that once you use it. Hold on, Kenny. Hold on. Zip it up.
Yeah, okay.
You use it in a way that you then bring it back to the policy. But while it's gone, it's still accumulating income as if it was still there.
Can I talk? You think there's a lot of money that's building up. It's not that great of money in that pot. I don't know what pot you're thinking about, but that pot is not that big. Vaughn, help me out, Vaughn.
Well, it depends on.
Let Vaughn talk.
I think what Greg is talking about, I'm trying to hit on both of y'all points. You can dump a lot of money into the right policy and borrow from that policy without taking the money out. You can put $15,000, $20,000 in a policy and use that $20,000 to buy some real estate, and you're not even touching your money. That's how those rich people got rich, and that's how they stayed rich. I mean, if you look at some of the history of these Walt Disney and these guys didn't spend no money. They got that money from their insurance policy. Everything went down except the insurance business. When that crash hit, everybody got hurt except people that had insurance. Mm-hmm. Insurance is the most stablest form of wealth building in the world. And
Well,
everybody has got rich from that.
but you
Then
have to.
next to that is real estate, because that's where you put the money at.
It's just, Kenny. It's just a different way of thinking, and I want to educate, number one, as you're saying, on the importance of being insured. I mean that's numero uno. We've got to be insured, and we're not.
It is the greatest investment. Where in the world could you put $50 in a policy and get $100,000? Where? You can't even go to a casino and get that.
And so it all depends, kind of to Kenny's point. It all depends on how much money you're actually funding. How much money? How large is the premium, and then how much you're going to overfund in order to grow. And so, as an example, Kenny, I've been paying $250 a month for somewhere around 2 years. I mean, for somewhere around 10 years for my daughter.
Right.
Somewhere around 10 years, maybe a little less. It's $250.
But Greg, very few people can afford to pay $250 for a kid, 18 years old. So very few people can afford to do that.
I agree, Kenny. But all I'm saying is, for those that can't afford it, let's educate them on what their options are. Because a lot of people don't even know that this is an option for them because they haven't been educated. And so they're either not investing their money in anything, or they're investing their money in the wrong thing. And a lot of people will tell you they have discretionary income to put whatever, $200, $250. I talked to somebody the other day. He's about 35 years old, and I was telling him about an IUL, and I said, can you spend $100 a month just to get started? And he said to me, I can spend $300 a month. But he's never heard of an IUL, hasn't been educated, has a good job. He's an electrical engineer, has a good job. He's got $300. And I was telling him all the benefits of an IUL. And some illustrations will show that if you pay enough, and most people can't pay $300, there's no argument about that. But those that can, let's educate them and let them know how they can build wealth inside of an insurance policy, just like the banks do. Now, I agree with you. Kenny is frozen up. That might be a good thing.
Well, at the same time, see, Greg and Kenny, we haven't been exposed. I hate to sound prejudiced, but we as Black people, we didn't know nothing about insurance. They had debit. Used to have people come to your house, and get $5 from you every week, and you just thought insurance wasn't not a big deal. But that same $20 we were spending a month, our parents could have left us hundreds and hundreds of thousands of dollars. And we just don't know enough about insurance in order to take advantage of it. And we need to educate people on the value of insurance, period. And because it's not like it is a long time ago. Things have changed. We have been exposed to all of this stuff. Ain't nothing here no more.
But even if you don't want to invest the money and be your own bank, then simply you start off with a certain premium. It could be $100 a month, $200 a month, growing inside of your IUL. And then every chance you have to put in some extra money, you do that. So you overfund it, so that, and then at a certain point, like my daughter, I think when she turns, I think it's 35 years old, she'll have enough money in her account that she doesn't have to make any more payments. There's no more payments. It funds itself for the rest of her life.
Right.
You have to get to that point.
That's a silver spoon, baby. But most people don't have $50 or $100 to pay for insurance, and they're not going to find extra money. I mean, that's the market. I'm middle class, and everybody's not, well heeled for that type of plan. There's a particular market for that IUL. And you can take it from here, Greg. We get back to whatever you want.
No. I agree with you, but I also think, we work in certain markets, we work in certain communities where the reality is they can't afford it. And so I get that. But at the same time, let's educate our people so that, like I said earlier, those that can afford to build wealth inside of an insurance policy where you're growing your money tax-free, that also and so these policies, these IULs, they will pay you a retirement. And so I've talked to a lot of my real estate agents, and a lot of my real estate agents have actually gotten IULs, index universal life policies, as another way for them to have a retirement, because most real estate agents, since they're independent contractors, they don't have a pension, they don't have a 401k. And so these IULs, funded correctly, overfunded, investing some of the money into real estate, will also pay you, the IUL, a retirement. Now,
and we also have mutual companies that pay dividends. We have been exposed to that now. I mean, it's some companies that I was looking at an illustration the other day where the first year the dividend was like $10. Next year the dividend was like $400, stuff like that. I mean, when you get a participating policy, it's nothing like that, period.
And I have a question for you, Greg. Do you want to target real estate salespeople you want to target just that market? Then you can do IULs all day long, and it makes sense if that's the market you're going to deal with. Or you just want to do everybody, which I'm kind of confused as to which market you want to get. You want to get everybody or a particular market or final expense market? It could go either way, but
no, I'm just saying, Kenny, and I'm really speaking from experience. I want to put out enough education to fit all needs. Now, I do believe in having insurance. Everyone should have insurance. I believe that everybody should have a cash value permanent insurance policy. Probably about 25 years ago, I didn't understand insurance like I understand it now. And so 25 years ago, I was offered to purchase a term policy. And the person said to me, buy term, invest the difference. You guys know what company they were.
Yeah.
And that's what they were selling me. And so that's all I knew. And they said it was cheap, and it was. It was very, very inexpensive for a pretty nice size face value. It was a 20-year term, but here's the problem with that. I outlived that policy. That agent for me was one and done. Once they sold me the policy for 20 years, I never heard from them. So they didn't tell me that maybe that policy could have been converted.
That's right.
They didn't educate me on anything. So here's what happened within that 20 years. I had kidney failure. And so now and I had a kidney transplant. And so now that temporary policy runs out. And now, as you know, it's very, very difficult for me to get a policy. So I've got to get, guaranteed issue. Now, if someone would have came to me or that same person 25 years ago and said, well, Greg, I think the best thing for you is some type of permanent policy, a whole life or universal life, or really, an IUL, then I would never have to worry about insurance for the rest of my life. Going through the kidney transplant wouldn't had affected my life insurance. And by now, 25 years later, depending on the type of policy I would have gotten then, I would have had 25 years later, a pretty good, cash value. And so the point is, it's all about education. And so what I think, I don't know that we target a certain sector or a certain age group. I just think that we educate everybody. Now, can most people afford an IUL? I'm not sure. But I do know that someone 35 years old, 30 years old, someone just born, the best policy for them, a child, is not a final expense policy. The best policy for them, if the policyholder can keep up with the payments, is a cash value policy, is a policy like an IUL, where they are covered, but now they can start building wealth like banks do inside of an insurance policy, where that money is growing, where you can actually take the money out, invest it in real estate or whatever. You can even take the money out if you have enough money in there, and the premiums have to be high enough where it can be part of a strategy to pay for college. And Kenny, as you know this, you're your own bank. And so you can borrow the money if you want to and not ever have to pay it back. You're your own bank. You know, when you die, you know, that death benefit will pay it back. You get the death benefit less, you know, the loan amount. So there's lots of benefits that we don't take advantage of. And the only reason why we don't take advantage of them is because we're not educated. Our agents aren't educating. Our agents are only selling what they know.
Well, we got a few companies that you can actually.
Wait, hold on, Vaughn. Can you hear Vaughn?
Yeah, I can hear him. He's low, but I can hear him.
Okay.
You can actually use part of your money for savings and part of your money for premium. And you can have access to that money anytime you want to. And I think that's a great idea, to pay your insurance and save money at the same time. I mean, you're gonna use the money anyway, so why not get an interest rate off of your money that's better than the bank?
Okay.
That's a good, and so that is a phenomenal point, because here's what we do, only because we're not educated. We put our money in savings accounts.
Mm-hmm.
We're getting less than 1% on those savings accounts.
Right.
And if we're sophisticated, we put our money in a CD, where the CD we're getting 1 or 2%. And when we take the money out to use, we've got it's taxable. We put our money into an insurance plan like an IUL or a whole life policy. The key is to overfund, but it's growing at 5%, 6%, 7%, 8% every single year. And when the stock market crashes, we don't crash with the stock market.
Right. There you go.
There's a floor where it's only going to go down, but so much. So in an insurance policy like an IUL, you never lose money. It never goes below what it would be.
Zeros are hero.
Bank account.
Never. Say zeros are hero. Okay, I think we covered everything, Greg. We started to repeat ourselves. I feel like we go.
I think we have you. I think you came around to our side, Kenny.
I just want to get people insured. I just want to get people with insurance. Any insurance policy is better than no insurance. That's where I'm at.
Absolutely. Nobody's arguing that. Nobody's arguing that. All right, you guys, look. Final words. What type of those that are watching now will watch later? We'll start with you, Vaughn. What type of advice would you give them in terms of insurance, getting insurance?
Well, I would advise them to be very, very discreet about how much they want to spend, because it makes no sense for you to have a policy and drop it.
True.
Because nobody wins but the insurance company when you drop your policy. I mean, I don't care if you pay just $50 a month. If you drop it, that's $50 you throw down the drain. So if you want to build some wealth, get an insurance policy. If you don't want to build no wealth for yourself, build something for your children. That's why we always like to call it not life insurance. We like to call it love insurance. Because if you leave somebody something besides a legacy of wisdom, you really left them something when you leave them some money. Leave somebody some money. That's what we need.
All right, I definitely agree with that. How
Yeah,
about you, Kenny?
I echo what Vaughn said. And get an insurance agent to work with you. Don't buy it off a TV and don't buy it off a radio.
Right.
Get an insurance agent.
All right. So I'd like. So this was good. I was hoping that we would disagree on something so that we could go back and forth. So I like the banter. I like that. And you know, I can always count on Kenny to take the other side. So this was good. I think the bottom line, and I echo what you guys have said. You know, I can talk building wealth because I call it, I don't call it life insurance. I call it wealth insurance. It's a way to build wealth. But the bottom line is get insurance. You know, whether it's final expense, which is fine, whether it's a whole life policy or universal life policy that's permanent. My preference would be for you to get something that's permanent, though. Because anything could happen. Happened to me, and so use me as a prime example. So now I've got to hustle real estate and other things so that I have living benefits, or I can take care of myself financially if any chronic or critical illness occurs. If I have to go into a nursing home or assisted living facility, I have the money to do so. I do. I think Kenny sold me a guaranteed issue policy, but I only had to get a guaranteed issue because that's all I could get because of my my background, my health issues, and so I have to make it up in other ways. You guys listen, and you don't have to do that. You can get the right policy with the living benefits, so that if something was to happen down the line, and we didn't talk about this, but a lot of the policies that we sell either come with living benefits.
Accelerated death benefit. But see, the thing about life insurance, you got to get it before you need it. Once you need it,
right, it's too late.
It's hard to get.
It's hard to get, and it's going to cost too much.
Right.
But the problem with that is the younger you are, it's harder for you to foresee the future.
That's right.
And spend money on your future, because we're of the age now where we're starting to think about the future. We're starting to think about retirement. We see our parents going through, or our aunts and our uncles, going through sicknesses. Because what Donald always says is you get sick before you die. And then when you're sick, who's going to pay for that? Who's going to pay for a nurse to come to the house? Who's going to pay for a nursing home or assisted living facility? A lot of the policies that we are selling, even the final expense, either come with those living benefits, or you can purchase them at a very inexpensive price as riders on your policy. And so simply by just getting insurance, you kind of cover all those things. All right, you guys, I'm not going to keep you guys any longer. We'll fight with Kenny later.
Yeah, next battle. The next round.
Hey Vaughn, I think we won round one with Kenny.
Okay, good. At least we won one.
I shall return.
And so like Nikki is saying, we'll end with Nikki. Like Nikki is saying, get some type of insurance. That's the bottom line. Get some type of insurance. All right, you guys. All right, everybody. Have a wonderful Wednesday. Thank you guys again. God bless.